Hi everyone, I hope so you will be fine. So guys, today I'm recording third video for group accounting or for consolidation accounting. So I have already uploaded two videos related to group accounting. So whatever questions we are discussing today, so these questions belongs to those two videos. So if you want to watch those two videos, I'll provide the link of those two videos in the description of this video. So here we go, guys. So we have a first question. Let's read the requirement first. So the requirement is we have to calculate the amount of goodwill resulting from this purchase, if any, would be. So simply you have to calculate amount of goodwill. So now let's read the question. So the question is they are saying a corporation purchased 100% of shares of J corporation. So we have A corporation, they have purchased 100% shares of J corporation. So it means here A is the parent and J is the subsidiary. And we have acquired 100%. So if you have acquired 100%, so there won't be any non-controlling interest. And we acquired the J for $600,000. So the financial information for J, which is our subsidiary, is provided below. So here we have a information. We have here J corporation. We have carrying amount and we have a fair values. So here we have a cash, carrying value is given, fair value is given. Similar, we have account receivables, inventory, total current assets, and their carrying amount is given, fair value is given. So we also have a non-current asset, PPE. So we have their carrying value and fair value as well. So here we have our total assets, right? So total assets include obviously current assets plus non-current assets. So then we have here a current liabilities, carrying value and fair value. Then we have a long-term liabilities, carrying value and fair value. Here we have a total liabilities. Okay, so if you will add current and non-current, so it is total liability. Then you have a common stock. This is the equity section. Common stock. Okay, this is the carrying value, this is the fair value, which is same. We have a paid in capital, additional paid in capital. Then we have a retained earnings, and then we have a total shareholders equity. So here we have total liabilities and shareholders equity. How much? 800, which is equal to the asset, right? Because assets are always equals liabilities plus equity. Now we have to calculate goodwill. So guys, we have already learned the format of goodwill, that how you calculate the goodwill. Whenever we calculate the goodwill, first of all, we need here, purchase consideration. Okay, purchase consideration we need. And then we need here always a fair value of NCI. And in this question, because we have purchased 100%, so you will not have any NCI value. So NCI will be nil here because you have purchased 100%. And for 100% purchase, how much amount you have paid? It is given in the question here. You have paid, guys, $600. So this is what we will take as a purchase consideration. $600,000. We have NCI nil value. So this is what is the total value, right? This is the format of goodwill I'm just explaining. We have already covered. Then from here, we always deduct fair value of net assets of subsidiary. Okay. When you calculate net assets, for net asset, we need a value of assets minus value of liabilities. Make sure we need fair value of identifiable assets and liabilities. Okay, fair value. And this fair value we need always add the date of acquisition, right? Date of acquisition. So here we go. Now we have to identify which assets are there for this subsidiary. So, and which liabilities are there, and we need fair value. So simply, if you will just go through, so these are the total assets of subsidiary, and we have to choose the fair values. So assets fair values how much? 150. Okay, 150. So because these figures are rounded in three zeros, so we can write here as 150,000. Then we have to deduct liabilities. If you will check, so this is the fair value of liabilities, 350, which includes current and non-current, right? So we'll deduct 350,000. So if you will deduct, so our net assets, of subsidiary will be how much? 500,000. So this net assets we will deduct from this value. Okay. And if answer is positive, so this is your goodwill. If answer is negative, this is called gain from bargain purchase. And your answer is positive because 600,000 minus 500,000. So there is an answer of 100,000. And this is called goodwill. And goodwill we always record as non-current asset, but in consolidated financial statements. Okay. In consolidated balance sheet, we will record as a non-current asset. So answer should be how much? 100,000 as a goodwill. So C option is the correct answer. Okay, guys. Then we have here another question. So if you will read the requirement first, they're saying what amount should be reported for consolidated retained earning. This is the requirement. We have to calculate consolidated retained earning in the consolidated statement of financial position on the acquisition date. This is really important thing because we have to know retained earning on the acquisition date, not at the reporting date. Not at the reporting date. You know, reporting date is the date when you will prepare first set of consolidated financial statement, right? At the end of year. That is reporting. But they are asking at the acquisition date. So I'm just quickly telling you here, guys, please remember the date of acquisition. Okay. So if you are preparing equity section for consolidated financial statement, equity section for consolidated financial statement. So we always need common stock of parent only. We need additional paid in capital of parent only. Plus we need retained earning of parent only at the date of acquisition. Parent only. And plus we need NCI, non-controlling interest fair value at the date of acquisition. So if you will prepare this, this is your equity section mainly. Okay. But when you prepare equity section at the date of reporting, if you're preparing equity section, so I'm just telling you. So please remember again, we will take common stock of parent only. We will take additional paid in capital of parent only. Then we need a consolidated retained earning. For this, we have a working. Okay. And then we need a NCI. And this also has working. Okay. But because question is about consolidated retained earning, right? And he's asking at the date of acquisition. So let me tell you guys, at the date of acquisition, consolidated retained earning will include the amount of parent only. Okay. This is the answer of the question. Okay. Of the parent only. Of the parent only. But if you are calculating consolidated retained earning, okay, at the reporting date, then it has separate format. This format I have already explained. So how you calculate consolidated retained earning at reporting date. So first of all, you need retained earning balance of parent. Okay, retained earning balance of parent. Okay, whatever you have at the date of acquisition, that retained earning you will take. Then you will add a net income of parent. You know, net income from the parent's income statement. You know, parent will prepare individual income statement. So you will take net income of parent, you will add here. Then you will add here parent share in net income of subsidiary. This you have to add in consolidated retained earning, right? But this way figure how you will calculate P's share. For example, if P has, let's assume 80% voting rights in the subsidiary. So we will take net income of subsidiary into 80%. So this is called P's share in net income of subsidiary. So this figure we will add. And then we will deduct here dividend. Which dividend? Which is paid by parent only. So this dividend we will deduct. So this is what is called consolidated retained earnings. Consolidated retained earnings at reporting date. So, but the question is about consolidated retained earning at the date of acquisition. At the date of acquisition, only the retained earning of parent will be the part of equity at the date of acquisition. Okay, please don't show the equity of subsidiary because subsidiary equity account is eliminated under consolidation process. So here we go. Actually, this is the answer here, right? At the date of acquisition, parents retained earning will be the consolidated retained earnings. So here we now will go through the question. They are saying that PINC acquired 80% of S companies outstanding common stock on December 31st, year one. So we acquired 80%. We have a 80% voting interest. So P's retained earnings total is how much? 600,000. This is parents. And subsidiaries retained earning is 400,000 on the date of acquisition. Okay, and this is the question, and he's asking what is the consolidated retained earning at the date of acquisition. I told you only parents retained earning will be reflected. So parents retained earning is 600,000. So this 600,000 will be our answer. Understood? I absolutely clear. Then we have a next question, guys. So they're saying when a parent subsidiary relationship exists, consolidated financial statements are prepared in recognition of the accounting concept of. Guys, please remember. So whenever we prepare consolidated financial statements, we always follow single economic entity concept. So what is single economic entity concept? Because there are two concepts are there, legal entity and single economic entity. Legal entity means what? Parent and subsidiary. Legally, parent is a separate company and subsidiary is a separate company. Okay, but when we prepare consolidated financial statement, we assume that this subsidiary is the one department of parent. So, and we assume parent and subsidiary as a single economic entity, as if they are a one entity. So based on this concept, we always prepare the consolidated financial statement. Okay, this is actually the answer. Based on economic entity concept, we prepare consolidated financial statement. So it is not a reliability, because reliability is about quality of information, right? That your information should be free from error, or it should be unbiased, right? And it is not a materiality. Materiality, it's about importance of information. Whatever information we report in the financial statement, that has significance for the investors, because that information affect the decision of investors, right? So this is not a materiality. So the answer is B. Then we have here, guys, another question. First, let's read the question. They are saying that what amount of total liabilities should be reported in consolidated financial statements. So guys, when you calculate liabilities, and when we prepare consolidated liability value, so we always need parents liabilities plus subsidiary liabilities, and we will deduct here any liability which is intra-company. So this is equals what? Consolidated liability. Because all the intra-company transaction will cover in the next lecture how these balances are eliminated, but intra-company balances are always eliminated. Intra-company income, expenses, transaction, whatever. So we always eliminate when we prepare the consolidated financial statement. So here we have to take parents plus subsidiary minus intra-company. This is how we will get consolidated total liabilities for consolidated financial statements. So now let's read the question. So KINC owns 70% of S. So it means K is the parent, S is the subsidiary. So S company's outstanding common stock. So K's liabilities total how much? 450,000, and S liabilities total how much? 200,000. Included in S, like I mean say in this amount. So included in S financial statement is 100,000 note payable to K. It means S has to give some money to K, and the amount is how much? 100,000. Okay, S owes some money to K. Okay, S has to pay some money to K. So that is, this is intra-company. So guys, what we will do now, intra-company we have to eliminate, because this amount is included. This 100,000 is included in this 200,000. So now what we will do? So we'll take parents liability, which is 450,000, plus subsidiary liability, which is how much? 200,000, minus intra-company, which is how much? 100,000. So if you will deduct, so 550,000 will be your consolidated liability. So which is correct answer? D is the correct answer. Now we have here another question. They're saying, let's read the requirement. So what amount should be included as liabilities in the consolidated balance sheet at December 31st? Again, you have to calculate consolidated liabilities. Okay. So again, what is the rule? We'll take parents' liabilities plus subsidiaries liabilities minus intra-company. Okay, intra-company transaction equals consolidated liabilities. Okay, guys. So here we go. Now let's read the question. They are saying that. So B company owned several subsidiaries at December 31st. The following table shows each subsidiary's total liabilities excluding intra-company transaction. They are saying in these liabilities amount, intra-company transactions are not there. It means you don't need to exclude anything now. It is already excluded. So they're saying the percentage of stock owned by B, because B is a parent company actually, and it has multiple subsidiaries, right? So they are telling you the amount of liabilities and percentage of stock owned by B is given in the question. So here they're telling you subsidiary B. First check, is it subsidiary or not? Yes, because we own 70%, so it is subsidiary. H is your subsidiary? No, because we owned 48%. So it is not our subsidiary. This is not our subsidiary. So then P, yes. P, yes. So it is our subsidiary because we owned 80%. And also our subsidiary because we owned 100%. It means we have only three subsidiary. Being a bar company, we have only three subsidiary. Actually, this broke company is our subsidiary, right? So first of all, we have to take bar company's liability, and I don't think so we are provided with the barred company liability. So parents liabilities are not given in the question. So we'll put it 0, but we have to take now all subsidiaries liability. So this is our subsidiary liability, 4 million. Then we have 7 million. So total became 11 million, 4 plus 7. Then we have a 5 million, total became 16 million. So we have a subsidiaries liability of my 16 million. Okay, we'll add actually. We'll add with the parents. Okay, and we don't have intra-company transactions. It means 16 million should be our consolidated liabilities, right? So now see what's the requirement. So option B is the correct answer. Understood? Now we have a next question. So what is the question? They are saying a company should recognize goodwill in its balance sheet at which of the following point? Guys, please remember, regarding goodwill, I told you in the first lecture that goodwill is recognized only in case of business combination. In case of business combination, only goodwill is recognized. Okay, what is business combination? I explained there. Business combination is the transaction in which one company will acquire the control of other company. That the transaction in which one company will become parent and other will become subsidiary. So that is called business combination. In case of business combination, only goodwill is recognized. We never recognized internally developed goodwill. No, we don't recognize. Now let's go through. As I told you, only goodwill will be recorded in case of business combination and when control is achieved, right? So they're saying number one first. So when goodwill is recognized. So here a fair value, the fair market value of the company's asset exceeds the book value of company's assets. So goodwill is recognized. No, not in this scenario. So then the company expects a future benefit from creation of goodwill. Guys, internally created goodwill we don't record, and by the way we expect future benefits, so it's a definition of asset. Okay, not a recognition of goodwill. Then goodwill has been created in the purchase of business. Yes, this is business acquisition, right? Business combination, I told you business combination is a transaction in which one company will acquire the control of other. So actually this is the answer. Goodwill will be recognized only in case of purchase of the business. Then cost have been incurred in the development of goodwill. Guys, please remember, internally developed goodwill we never recognize, right? So whatever cost you have incurred. Okay, so answer C is the correct answer. Now we have here another question, guys, on your screen. So what's the question? So they're saying, let's read the requirement first. They're saying which of the following must be account must the accountant do when preparing the financial statements? Okay, for this we have to read the question now. They're saying like what accountant has to do. Okay, so they're saying company Alpha purchased company Beta 6 months ago. So we purchased after the close of fiscal year in which the combination occurred. So you can assume at the end of reporting period, the parent company, because they told you this Alpha is the parent. So the parent company's accountant is preparing the consolidated entities first full set of consolidated financial statements. So accountant is preparing first consolidated financial statement. So which of the following must be must the accountant do when preparing? So let's have a read. Let's look at the requirement. Number one, they're saying add all line item of assets, liabilities, revenues, expenses, gains, and losses, including other comprehensive income of subsidiary item by item to those of the parent. Yes, actually it is correct. Okay, but if there are intra-entity transaction, that should be eliminated, guys. Okay, when you're adding assets, liabilities, revenues, expenses, gains, losses, and OC items of parent and subsidiary. So this is actually the correct statement. Okay, now let's have a look. B, combine the equity balance of parent and subsidiary. No, when we prepare consolidated financial statement, we show equity of parent only. Okay, I told you at the start, we show parents common stock, parents additional paid in capital, we show consolidated retained earning. Okay, I told you in the first question, and then we show NCI value. Okay, so we don't merge equity of parent plus equity of subsidiary. No, this is incorrect. Then report goodwill from acquisition of the subsidiary as consolidated current asset. This is correct statement till here, but goodwill is not your current asset. Goodwill is your non-current asset, right? And it is shown only under consolidated balance sheet. Then this is incorrect, right? So then report the investment in subsidiary. It's also incorrect because when we prepare consolidated financial statement, so the investment in subsidiary account is eliminated. And this point I have explained in my lecture. Okay, investment in subsidiary account only, it will stand in individuals or in the parent's financial statement. But when you will prepare consolidated, so as we assume we are a single entity, so investment in subsidiary account is eliminated. So this is also incorrect. So option A is correct on. Then we have other question. They're saying when one company purchases a majority voting interest in another company. Majority voting interest means that you are acquiring more than 50% of voting rights. So the equity on the consolidated balance sheet at the acquisition date equals. Okay. So they're saying what equity you will show, but at the date of acquisition. I told you already at the date of acquisition, only parents' common stock will be reflected, only parents additional paid in capital, only parents retained earning at the date of acquisition, and NCI fair value. Okay. I'm assuming if you have other comprehensive income, that's also only of the parent, right? So now they're saying that the equity on the consolidated balance sheet at the date of acquisition equals what? Fair value of parent's net asset plus fair value of subsidiaries net asset. No, so net asset means like equity, but we don't show subsidiaries equity because it is eliminated. This is incorrect. Then combination of subsidiaries equity and the parent's equity, no. Then again, we don't show subsidiaries equity. Then parents equity just prior to acquisition, yes, plus the fair value of any non-controlling interest, yes, because all these three values belongs to parent. And NCA, yes, this is correct statement actually. Then sum of parents equity and the subsidiary equity, no, we don't make the summation of parents and subsidiary. So this is also incorrect. So C is the correct answer. Then we have another question they are saying, which of the following statement is an example of variable interest entity? You know, guys, I told you we covered this point in the first video. Also, I told you we have a voting interest entity and variable interest entity. Voting interest entity means say if you acquire control through the acquisition of majority of the voting rights. But variable interest entity means say even you don't have majority of the voting rights, you don't have more than 50% of voting rights, but still you have a control. This control can be passed through the contract, right? So that is called variable interest entity. So they're saying which of the following statement is an example of variable interest entity? model of consolidation. Okay, these two terms I have already explained. So they're saying a company alpha on 60%. No, it is not variable interest. It is a voting interest entity. So he's asking variable interest because here you own more than 50%. Variable interest entity will be there if you don't own more than 50%, but you have control. Then company beta owns 25% of the company's alpha. Okay, so it is less than 50% and has no significant control. So you don't have a control. So actually it is not variable interest entity. Variable interest entity means you should have less than 50% voting right, but you should have a control. Here you have less than 50%, but you don't have a control. So this is not a variable interest entity. So this is the interest, this is the definition of variable interest entity, right? You should have less than 50% voting rights and you should have a control over subsidiary. But here you don't have a significant control. So this is incorrect. Then C, company alpha and company beta from strategic partnership to develop a new technology. They're saying strategic, just you are a partner. So it doesn't mean you have a control over your ally. Okay. Then company beta owns 33% of voting staff of company alpha. Yes, so it is less than 50% and has the power to control the activities of alpha. It means both conditions are met. Now, this is the definition of variable interest entity. This is the correct answer. Then you have another question. They're saying here what you have to calculate. They're saying the consolidated financial statements of acquirer corporation and its wholly owned subsidiary must reflect. So we have to read the question actually. So they're asking about consolidated financial statements. Here we go. And if you will go through the requirements, the option goodwill again, a deferred credit, it means they're asking actually they're looking for the answer of goodwill or gain from bargain purchase. So it means you have to calculate goodwill or gain from bargain purchase. Okay. So now let's go through the question now. They're saying acquirer, a corporation acquired for cash at $10 per share, 100,000 shares of outstanding common stock of acquiring company. Actually, guys, what happened? So there's a parent company and the parent company has acquired 100,000 shares of subsidiary and parent company paid $10 for each shares. Actually, indirectly, parent company has paid $1 million to acquire the subsidiary. Okay. Then they're saying the total fair value of identifiable assets acquired minus liabilities assumed of acquiry was 1.4 million. Actually, it is the net asset value because he told you assets minus liability. It's a net asset. We need net asset and we need fair value. It's a fair value. Okay, it's a fair value. They're saying including the fair value of its property, plant, equipment, it's only non-current asset of 25,000. They're saying this value includes, because this value includes the PP value of 250,000. So, okay, no problem. So now you have to calculate consolidated statements of consolidated financial statement of acquirer. Okay. How would you calculate, guys? So simply, I told you we will take purchase consideration. Purchase consideration is 1 million. As I told you, we acquired 100,000 shares and we paid $10 for each. So purchase consideration 100,000 and there is no information about NC, so ignore it. So then we'll deduct here net assets value. So net asset is how much? 1.4 million is given. This is already fair value of net assets, 1.4 million. So if you will deduct here, so you will get here negative answer, which is 400,000. And by the way, this 400,000 is going to be your gain from bargain purchase. So it's a gain actually, 400,000. So which is a gain of 400,000. So this option is correct. See. Okay, guys. So thank you so much, guys. See you in the next video. Thank you so much. Bye bye.